Hey everyone, my name is Luis G. Welcome. Today I want to talk to you about a video that came to me a couple days ago. This particular video is comparing today's real estate market, the mortgage market, the home purchase markets, just home prices in general to 2008, and basically concluding that what we're seeing today can be equally or even worse than 2008. So what I wanted to do is look at that video and give you some feedback about looking at data, right? A lot of people think that data is very unambiguous, that data cannot lie. That is far from the truth. You can use data, you can spin it in any way to support your thesis, right? But as a good analyst, you have to understand what people are telling you, why they're telling you, and find out, are they using the data correctly? So that's the point of today's video. I want to take this video that was given to me. What we're going to do is look at it together. I'm going to pause and I'm going to give you my feedback on some of the data, the way it's being interpreted by this individual. Now, you may not know who I am, so I'm going to spend a minute here telling you a little bit about myself. I started in the financial services industry 19 years ago, June of 2003. I graduated from UC Santa Barbara with a triple major. I did business economics, psychology, and I did Spanish. I got into the industry, I was just 21. I've been doing this my whole life. During my tenure, I've attained the highest designations when it comes to financial planning. I'm a certified financial planner. I have the highest designation when it comes to portfolio management, security, selection, and analysis. That's a chartered financial analyst. I attained that several years ago. It's one of the hardest tests that you can take. In fact, less than 10% of college grads that are in the industry that attempted actually earn the right to use that CFA designation. So it's a very difficult designation to get. It teaches you how to analyze things, how to look at data, interpret it very properly, which is very relevant to today's video that we're going to be looking at. And recently I got the Chartered Market Technician CMT designation. That's what technical analysts use to look at companies, at their charts, patterns, to be able to enter and exit securities and make a profit. So have a couple of the designations, but we'll leave it at that. That's a little bit about my background. I do work for a wealth management firm. I'm the director of investments. We manage hundreds of millions of dollars for clients. I'm on a team that manages clients with a minimum of 25 million. And so I've been doing this for a long time. I know how to analyze numbers. I'm going to give you my perspective. The reason I'm doing this video is that you'll see, if you go ahead and watch it, this particular video done by this gentleman, it's about 20 minutes long. And he says in that video, if you have a different opinion, go ahead and post something and tell me why. So that's what I'm going to do. I'm going to take him up on that offer and I'm going to tell him my interpretation of the same data he's looking at. And I also challenge you to do the same. I'm going to present my case. If what you think I'm presenting is not accurate, go ahead and challenge me, but do it with data. Don't give me opinions. I think this, show me the data, show me the same data that I'm going to present, which is the same data that this gentleman presented, and then we can have a dialogue. So let's kick it off. I'm gonna go ahead and share my screen. And you might recognize him. He's Patrick Bet David. He has a lot of followers on social media, on YouTube, a lot of followers on Instagram, and I don't know a whole lot about him, so I'm not going to criticize him. That's not the objective. My objective is simply to take him up on his offer, to present a different point of view based on data. That's all I'm doing, and I ask you to do the same with me. So let's go ahead and kick it off.
Today, we shot a market crash video, and at the time, I knew the market was not in good shape, but the last 30 days, based on a lot of research and a lot of data that we've looked at, which I'm going to share with you, as bad as I thought it was, it's a lot worse. Now, you get to do whatever you want to do with this data. Dave Ramsey calls it fear porn, saying there's a lot of people getting scared and they're excited about the markets. Nothing's going to happen to the market. It's going to be all right because the inventory's not taking a hit. I'll give you data. You read the data, free PDF, choose whatever you want to do with it, then make a decision for yourself. Because when you look at $3 trillion of wealth being lost in retirement in the first 6 months, $1 trillion in crypto, And you know that domino effect, because the question becomes, is it too late? Can we do anything about it? When people stop making money and their wealth goes away, they have less disposable income. When you have less disposable income, there's less spending. When there's less spending, there's lower business profits. Lower business profits leads to layoffs. Then it's unemployment, and it's foreclosures and bankruptcies, then divorce, crime, drugs, OD, alcohol, protests, riots, back at it again. Sounds scary.
So let's go ahead and pause there. He calls this, there's data, right, to support this cycle, right, painting a very bleak picture of what's going to happen out in the economy, unemployment, alcoholism, people doing drugs, couples being divorced, riots, right? I don't think that's going to happen. That's my opinion. I don't think, and this video, by the way, is called Another 2008 Housing Crash or Worse, the Real Estate Bubble Explained. I'm going to show you data why I don't think it's anywhere close to 2008, just like this gentleman confirms. And I welcome him as well to challenge me. When you watch this video, feel free to reach out. I'm happy to have a dialogue. But let's go ahead and continue. I'm going to start by just looking at data points, right? So I'm going to go to 440 in the video where he starts presenting his
Number
data
one,
points.
mortgage application volume was 52.7% lower last week compared to the same period 1 year ago, according to Mortgage Bankers Association. Now that's mortgage application, which means I may be buying a house and I want a loan for a new mortgage of a house I'm buying. But watch refi. Applications for refis on existing mortgage dropped 75% from a year ago, according to the MBA's Refinance Mortgage Application Index.
Let's pause it there. I'm going to show you my first data point. He talks about the Mortgage Bankers Association, MBA mortgage application. He talks about that it's dropped, but more specifically in this part, he talks about the refinancing index. So what I've done is I pulled the same exact data that he's pulled. He said it's dropped about 75% year over year from the time he's looked at it. So what I did is I went in here and I'm looking at the data. So looking at the right-hand part of the chart, it absolutely has dropped quite a bit. In fact, if you look at the peak to trough, right? So the peak here peaked, this was March 9 of 2020, all the way to where we are today. 718 is the latest data print. It's dropped about 89%, so even more than what he's saying. That is very true. But what he goes on to say, it's because mortgage applications, especially refinance, have gone down. That is going to basically somehow lead into a lot of layoffs. It's going to lead into home prices going down quite a bit. So the first thing I ask myself when someone gives me a data point is, has this happened in the past before? And looking at the chart, it certainly has. It happened during the Great Recession. You see a peak to trough, a big decrease. But what people don't recognize is that back in 2003, there was also a refinancing boom where it went up quite a bit, almost to 10,000, right? This was back in 2002, July. And a year later, it dropped all the way down to about May, or actually in a year period, it dropped about 84%. So very close to what we've seen decrease now. So the question is, or the answer is yes, it's happened in the past before. And you might be asking, well, so what? Well, here's how you use data. If it's happened in the past, and his thesis is mortgage applications come down, that's going to affect, that basically shows there aren't a lot of people wanting to buy homes, and that's going to make home prices go down. Well, if this situation has happened in the past, let's just go see what home prices did during this period of time, right? And this period of time actually is from June of 03 to June of 04. What we're seeing here, this big decrease that I'm going to compare. So what I'm going to do is go to Fred. This is a free site that you can go on to. It's by the Federal Reserve, obviously a very legitimate site. You can go on here and grab the same data that I'm getting. You can also DM me if you want. I'll give you the slides so you can look at it and you can chop the data a little way you want as well. But what I did is I put two red printings here on the chart during that period. During that period, home prices actually increased 13% year over year. They did not decline. So let's go back to his thesis. Mortgage applications, refinance drop significantly. Therefore, home prices are going to drop. Well, let's go back. It dropped significantly, this refinancing index, but home prices did not drop during that period, right? And you can look at other periods as well, but this is the period that I focus on because it has the largest decrease from peak to trough relative to what we're seeing today. So I would say the thesis does not hold, that if you see this refinancing boom decrease a lot, that automatically means that home prices are going to go down. Now, of course it can, but that doesn't necessarily mean that it will. So what I'm looking for here is when you tell me something's going to happen, if I find evidence that in the past that's not the case, you cannot tell me with certainty that's going to happen. Anyone can say anything, yeah, well, it could go down. Of course it can, right? Think about it. Even a clock is wrong twice, right twice a day. So you got to pay attention to the data. So I would say the first one, thesis doesn't hold. Let's go back to the video actually here before we go into the 30 fixed rate of the mortgage here. And let's find the video. We're going to be looking at, this is going to be 654 in the video. So actually, let's go back here. 654. Let's just play it here.
Musk said, prepare, and I'm advising you to be prepared so you can persevere. So let's say, what if it goes to 9%? I think it's going to go to 10%. I think it may even go higher than 10%, but I think it's going to touch 10%. Let's take a look at the history of interest rates. If you look at this chart from 1970 till today it shows around 5.7% interest rate. If you go back a couple years, you'll see 3%, 2.8%. You see how low it is right there. Now, if you go back 20 years ago, you'll see it was at 5.8%. Here's the crazy thing. If you go back around 2008, 2007, and go all the way back from 1970 till around 2007, 2008, rates were never below 5.7%. If you gradually move back, you'll see it go to 6%, 7%, 8%, 9%, 10%, 11%, 18.5% during Jimmy Carter.
Let's pause it there. So he goes on to talk about the 30-year fixed rate mortgage. And so what I did, again, I'm going to pull the same chart he did. This is directly from Fred. That's where he got the data as well, looking at the 30-year fixed rate mortgage. It's the same exact chart going back to the 70s. That's the most data you can get. That's why he went back that far. And you see what it's done. Yeah, you can see here it went to 18.5% during the 80s. So far, so good. But he goes on to say, because it's gone up that much to 18.5% in the past, that he thinks 10% on a 30-year fixed rate mortgage is plausible because it's not as high as it was back then, but at some point it was there and it went even higher. That's the argument that's being made. What I want to do is think through, well, why was the 30-year fixed rate mortgage so high back in the early 80s? Think about that. And the answer is inflation. Inflation was very hot during that period of time. And so what you saw is that the 30-year fixed rate mortgage also increased because of inflation. So that's going to be the key here. Do we think inflation is going to run out of control? And if so, then 10% might be plausible. But if it's not, if the CPI inflation is not going to run out of control, 10% is not plausible. So let's kind of think through it a little bit, right? Here's the same chart. All I did here is add the consumer price index in red. So what you see is inflation goes up, and then you see mortgage rates go up, right? That's what I told you, and then that's what he's saying here on the right-hand side. Inflation is going up, and so the 30-year fixed rate mortgage is going to go up as well, and it's going to go up just as high. I would argue that's not the case, but I want to give you some facts behind it. I first want to talk to you about not just my opinion, but I also like to look at the opinion of other professionals. This is from FactSet. They look at 52 economists, the top world economists. They gave their forecast of where they think inflation is going to be in 2022, 2023, 2024 for the G7 countries. We're just going to look at the United States. What they think on average is that in 2022, inflation is going to be 7.8% on average, right? So 2023 is going to come down to 3.3 and 2024 down to 2.2. So the economists themselves don't necessarily think inflation is going to be a big issue down the line, right? Going to 23, 24. Why? Well, because the Federal Reserve is going to raise interest rates to tame inflation. How are they going to do that? As they raise interest rates, they bring the economy down. When they bring economy down, they bring the demand down. That means inflation is going to subside as well. But don't take my word for it, right? Give me your opinion. So let's talk about what causes inflation. There are three things: demand pull, cost push, currency depreciation. We're only going to focus on the top two because that's relevant to what's happening today, right? If there's a lot of money out in the economy that people have in their pocket and they're using to spend to buy goods and services, and there aren't that many goods being produced or services available, that's going to cause inflation, right? Because everyone has money and they want to buy things that you can't really get. You're going to see that, right? You saw that earlier in the year, last year with watches. You saw it with cars. Everything got out of control because there was just a lot of money. The second thing that could happen is cost push. That means the raw materials that the company use to build things, if that increases, they pass those costs along to the consumer by higher prices. So those are the two things we're going to focus on. We're going to cover it very quickly. So what happened? When COVID happened, the economy got shut down. When the economy got shut down, what we saw is that the government wanted to stimulate the economy. So two things happened. The Federal Reserve started to print money, but more importantly, the government actually started giving people money directly into their pockets. Remember, their checks were being sent. People that were unemployed were actually getting paid more to sit at home than they were to start work, but they had money. They had money, and there weren't a lot of goods being produced. The supply chain got bottled up. There weren't a lot of goods, a lot of services, a lot of money chasing few goods that caused inflation going up. Let's think about in the future, what's going to happen. Well, the federal government is no longer giving free money away directly to the consumer. The Federal Reserve printed a lot of money, but now they're starting to unwind that through quantitative tightening. So I don't think inflation is going to be a big issue going forward. If you also think about what's happening with inflation, you tend to see that back in 2008 and 9, when we got into big trouble with the Great Recession, the Federal Reserve started the quantitative easing 1, 2, and 3. They printed a lot of money, but remember, we did not get inflation, even though the Federal Reserve printed a lot of money. Why? Well, that money that was printed was given to the banks, and the banks kept it in the bank. So they didn't actually give it to the consumer. Therefore, money was not in the economy, and goods and services were not purchased. So that's the key difference between back then and now. Now we had inflation because that money got given directly to the consumer by the federal government. So that was the key issue that caused inflation. But that's going away because the federal government's not giving money away directly to people anymore. Let's look at cost push, because that's been a challenge. That started this year with the war with Ukraine and Russia. Because of that war, we had higher oil prices, higher food. So energy prices, food prices went up a lot. So that's the next challenge of what's causing inflation. At some point, that war is going to end. Longer term inflation is not going to be an issue. That is my opinion. I'm showing you the why here. You look at this. If you disagree, tell me why, but use the numbers, use facts, and use historical figures why that's the case. And I'm happy to hear your opinion. Look, let's go over to the bond market. The bond market is a $1 trillion market. What they're doing is investing real dollars, real money here. Institutions, people, investors are buying bonds based on expectation of inflation. I won't get into all the details of how they do it, but in essence, what you're seeing here is a 10-year break-even inflation rate. All that tells me is what the bond market, again, $1 trillion market, what they think inflation is going to be. Look at this chart. Yes, inflation expectations have gone up, but they've subsided. They're going down now. They're less than 2.5% on average over the next 10 years. All that means is that the bond market thinks inflation is going to average right now about 2.5% annually for the next 10 years. This is key. Remember, you don't make investment decisions based on the data you have today or you got this month. You make investment decisions based on expectations over a long period of time based on the horizon of your investment. So don't get confused if someone says inflation right now is hot 9.1%, it's getting out of control, because you're not investing for 1 month, you're investing for long term. So you have to look at the long-term average. I'm showing you here is 2.5%, what people are thinking. So let's go back to the video here and pick up where we left off. What we're gonna look at now is go to 1020, and we're gonna talk about why he thinks home prices are gonna decrease. So let's go there.
And hey, I want to buy a house right now. You may want to wait another year till you buy a house. Just watch this data here and you make a decision for yourself. So this is from Realtor.com showing active listings, and you'll see the different colors represent different years: 2017, 18, 19, 20, 21, 22. I want you to focus on 2022 all the way at the bottom, which is yellow, you'll see the active listings in January goes down. If it goes down, property value goes higher because there is less inventory for you to buy a house. For example, if I make an offer on a house here and I'm saying I want to buy a house that's close to this schooling because I want to send my kids to this private school, and my realtor says there's only 2 houses in this market with a swimming pool, I don't have a lot of options. There's only 2 homes. If there was 50, I can negotiate and say, if you don't give it to me at this price, I'll go over there. But if it's only 2, they're going to get 50 off.
Okay, I'll pause it there. Again, you can go watch the video if you want. I'm going to bring up the same data that he had from realtor.com, looking at the same exact chart that he's looking at, the active listing count. You can go pull it. You can ask me. You can ask him as well for the data. But what you're seeing here, yes, you see that yellow line going up, and it's up 18.7% year over year. And it's a scary number unless you think about, well, why? What's happening? What's behind the number? That's the point of being a good analyst, is the why. Don't just take the number for what it is. If you look at 18.7 year over year increase, seems pretty scary. But let's think about what's going on. When you start comparing this year versus last year, well, remember, people weren't selling their homes. People were still scared of COVID. No one wanted to list their homes. We actually saw that there weren't any listings. And so that's what you're seeing, because you're starting from such a low depressed number. Anything that increases will increase substantially on a year over year basis from a percentage point of view. But look at 2022 and compare it to pre-COVID. Look at 2017, 18, and 19. They're all up here. So even though year over year we're up 18.7%, the absolute number of listings is 619,000 units. But look where we were at this point in time prior to COVID. We were way higher, over 1 million units back in 2017, 18, 19, which tells me during a normal market environment, I would expect a lot more homes out in the market. So therefore, I'm not scared that it's increasing. I expect it to increase because it should go back to its average. Just look at prior COVID, pretty tight where it was. It's gonna go back up to this point. That doesn't mean that home prices are gonna decrease. Let's look at another point. This is the inventory of unsold existing homes. It's published by the National Association of Realtors. All it's saying is the number of homes supplied monthly. In other words, if the current demand of people buying homes, when would the home market exhaust its inventory? So the higher the number, it takes longer. That means more homes are out there. Right now it's at about 3. This number just came out. It got to as low as 1.5 at the start of the year. So it's trending up. And people are using this number. Oh, it's going up a lot. It's scary. Not really. Compare it to its average. Compare it to where it was back in 2008 and 7. Remember, that's what the point of the video that was made by this gentleman was. It's bad. It's worse in 2008. Well, look at the data. We're here at 3. Look how high it got almost to 12 back during that period of time. And we're still below the average if you think about it. We're way below the average, even before the boom, the Great Recession, and even prior to COVID. So no, I don't think because there's more inventory coming in the market that home prices are going to decrease. Can it? Of course it can. But the point is to understand why, right? And I don't necessarily think so. Again, if you want to challenge me, go for it. Just come with me with data. So let's go ahead and continue the video. And we're at 11, so we're going to go to 13 and talk about layoffs.
So that's pretty realistic. But what if it goes down 60%? What else takes a hit? Steel, furniture, construction, all of those industries also take a hit. This is why it's all intertwined. But let me continue. Remember at the beginning when we talked about the fact that less disposable income leads to less spending, lower business profits, layoffs, unemployment, foreclosure, bankruptcies, divorce, crime, drugs, OD, alcohol, protest, riots. Okay, what does this lead to? Layoffs. There's layoffs everywhere. Compass, I love Compass. I've done business with Compass for many, many years. They're great. Compass is letting go 10% of their sales. Compass is like the high-end community realtors.
I'll let you watch the rest of the video, but basically he's saying there's going to be layoffs, right? He's trying to scare you. People are going to be laid off. And the answer is, of course, there's going to be layoffs by design. Remember, the question is not just there's going to be layoffs, but why is there going to be layoffs? Well, I'll tell you why, because the Federal Reserve is increasing rates. We all know that rates are going to go up. The Federal Reserve is going to be next week. They're expected to raise rates by 75 basis points. They're increasing rates very quickly, short-term rates. Why? Because they're trying to tame inflation. So when they raise rates, what do? They lower the economic growth. The economy goes down. So what happens when the economy slows down? You're going to get more layoffs. Unemployment rate is going to go up. It's not scary. It's part of the economic cycle, right? Don't get scared by all this economic data that's going to come out. It's by design. Look at this chart. We're going back to the 50s. What you're looking at here, unemployment rate in blue, federal funds rate in red. What you see here is when federal fund rates go up, unemployment starts to go up. And you can go through the chart. Look, right here, red goes up, blue follows, red goes up, blue follows, red goes up, blue follows. So what's going to happen here? Red's going up, Fed funds rate, right? Fed's raising rates, unemployment will go up. It's part of the normal economic cycle. So you, as a person, what you want to do is position yourself so you're not the one that's let go. So you want to make sure that you're at the top of your field, the top of your industry, the top of your company. And there's a lot of things that you can do, but that's not the point of this video. I just want to show you that don't get scared by these unemployment numbers because it's going to happen. It's happening by design because the Federal Reserve wants to slow the economy. When they slow the economy, they slow demand. How do they slow demand? Because people get let go. They don't have money to buy things. And what does that do? Slows inflation. Remember, inflation is the big problem. So how do we solve for it? Just told you the little cycle. Got to pay attention to it. Let's go back to the video. Now we're going to go to 1420, where he talks about foreclosures.
Mind, he doesn't get paid to do this. He's in the industry. So Freddie Mac knows something about this because they've been through this before, but they're also saying it's going to be worse in 2006, which the last one I'm going to share with you in this topic is foreclosures. Why foreclosures this early? Aren't foreclosures are supposed to happen 6 months from now, maybe next year? What would you say is the increase in percentage of foreclosures that we have in 2022 compared to last year, same time? What do you think the increase is? 20% more foreclosures? 40% more foreclosures? 60% more foreclosures? Wow, it's not going to be 100%, right? You ready? We have 700% more foreclosures this year, same time than we did last year. Let me say that one more time. 700%. 23,204 foreclosures, according to the database management company ATTOM, Data Solutions. That's 7.
So again, anytime you're going to challenge someone, you have to come with data. So what I'm going to do is pull the same exact data source. Look, ATTOM, right? That's the data that he has. And we're going to talk about that. And I'm going to give you my interpretation. This is US foreclosures. When you look on the far right, you get to see that there really is a 700% year-over-year increase in foreclosures. You see this big bar here is much greater than the bar a year ago during the same period. So it has increased 700%. If you just stop there, it is a scary number. But remember, you're thinking critically now. You have to understand why. So let's go back. Why? Why is it so depressed here? Why were we such at a low number here? I'll give you 2 seconds to think about it. Why were we so depressed? Well, remember, there was a memorandum that said you could not foreclose on renters. Remember that? Why? Because of COVID. It was something that was passed by the government that said, if someone doesn't pay you rent, you cannot kick them out of the house. You can't do that, right? And so what that ended up doing is basically depressing that information or depressing that number. Now that people can get kicked out, or now that you can foreclose on someone who has a mortgage, right? Not just a renter, but someone who actually has a mortgage that has not been paying it. Back during the COVID era, you had a little bit of a safety net that you couldn't get kicked out. But guess what? Now you can. So what's going to happen? Well, those banks that own the mortgage, they're going to say you need to leave if you don't pay. So of course they're going to start kicking people out. So that's key. Why is it 700%? Well, they couldn't foreclose on anyone back then, but now they can. So of course it's going to increase. So you might be thinking, hey, that's scary. Not really. Remember, the point of the video is to compare 2008 until now. Let's go to 2008 and find out what was happening. Look at how many more foreclosures there were back then, right? Looking at more than 500,000 foreclosures. Right now, we're less than 100,000. So it's not that scary. When you just think about the 700% year over year, it is. But when you think about it, oh wait, banks couldn't kick people out of their house. because the government didn't let them, but now they can kick people out for not paying their mortgage. So they are, right? And it makes sense. The bank should have the right to do that because they're in business to make money. And if you have a mortgage, you promise to pay it back. You should pay it back. And if you can't pay it back, unfortunately, you're going to be asked to leave. So you're going to see foreclosures increase, but nowhere close to that level. It would have to increase so much more before it even becomes an issue. So no, today's foreclosures issue is nowhere close to the Great Recession. Let's move on to the video. And what we're going to look at is home affordability. And that's at 1544.
Here because we printed way more money. Now, this next data, simulators of 2008 versus today. In 2008, okay, the average worker, say he made $80,000 a year, whatever the number is, the house prices at the time were 8 times the average worker's earnings. So 8 times 80 is what? $640,000, right? You know what the number is today? 8.5 times. So if in 2008 was 8 times, the average American's like, I can't afford to buy that big of a house. What are you talking about? It's 8 times my income. It's crazy. Don't worry. It's 8.5 today, okay? Which means it's worse than what it was.
Let's bring that up. And again, my goal is not to criticize. My goal is simply to look at the data and give you my interpretation of it. Looking at this home affordability, I agree with Patrick Bet-David that there is a challenge here from a home affordability perspective. Look at this data by the Federal Reserve of Atlanta. The lower the bar, the less affordable relative, right? Home prices relative to income. And so what you see here is things got really bad right before we got into the Great Recession, when home prices were booming back in 2005, 6, and people couldn't really afford those relative to income. Then home prices went down and then affordability increased. But now we're back where affordability has decreased significantly because home prices have gone up a lot and the monthly payment has increased a lot over the last, call it, 7 months from the start of the year because mortgage rates have increased. So home affordability has absolutely decreased, and that is a challenge, a headwind to the home markets, right, to real estate. But that does not necessarily mean that it's going to crash. All it means is that we're unlikely to see these year-over-year home price increases of 15%, 18%, 19% that we've seen year over year. We're more likely to start decelerating, right? Keep in mind, I'm saying decelerating. I'm not saying home prices going down, negative, but not growing as much. So rather than growing at 18, 19%, they're going to start growing more towards a longer term trend of, call it, 3 to 6% on an annual basis. So that's what's likely. Of course, home prices can decrease as new data comes in. We're analyzing it, but right now, I don't necessarily think home affordability is going to cause the market to crash like it did in 2007, 2008. That's just not the case, even with this here. Right, you could watch the video. It goes on to talk to about a couple other things of how you can prepare. I think there were pretty good ideas of how you should prepare. That I think Patrick Bet-David did a good job. Make sure that you make yourself more valuable to your employer if you're self-employed, which is really key. And we agree philosophically, he and I, in terms of the American dream, really being an entrepreneur. That's what you want to do. That's where the money is. You want to make sure that you make money for you and your family, so you live the lifestyle you want. Really, if you're going to do that by being an entrepreneur, not just by being a W-2 employee. So I definitely agree with David on that. I want to leave it with this, right? I at least want to give you something. And what I want to show you is a 30-year fixed rate mortgage. That's what you see in red. And then the 10-year US Treasury yield, that's what you see in blue. So the question is here, what's going to happen to the housing market? Well, to know what's going to happen to the housing market, we have to look at what's happened to the mortgage industry. Well, what's happening to the mortgage industry, you have to pay attention. Well, what's happening to the 30-year fixed rate mortgage, which most people, that's the mortgage they get. In order to understand what's happening to the 30-year fixed rate mortgage, you have to look at the 10-year US Treasury yield. Why? Well, because the 10-year US Treasury yield is the risk-free rate. And what I'm showing you here is looking at history, the 30-year fixed rate mortgage has always traded above the 10-year US Treasury yield by a spread of about 1.7 on average over this long period of time. So what that tells me is that if you want to know where rates are going, a 30-year fixed rate mortgage, you have to know where the 10-year US Treasury yield is going. That yield has gone up quite a bit because of the problems with inflation. So we saw the 10-year US Treasury yield at the start of the year just spike up quite a bit, but now it's starting to subside. So there are two opposing factors. If inflation is going to be an issue, the 10-year US Treasury yield is going to go up. But if we run into a challenge with the economy and the economy starts to struggle, people are going to buy long-dated bonds, US Treasury bonds for safety. When you buy bonds, the yield goes down. If the yield goes down, you could see that the 30-year fixed rate mortgage is also going to go down. So you cannot tell me that we're going to see the 30-year fixed rate mortgage at 10% and we're going to see chaos where the economy spirals under control. That just can't happen. It's inconsistent. If the economy spirals out of control, you're going to see the 10-year US Treasury yield go down, and so will the 30-year fixed rate mortgage, right? That's just the way it is. Look at the relationship there. If you disagree, go ahead and tell me why, but tell me what data. So that's it. That's what I wanted to show you here. Again, go through some information. I wanted to go through the video. My point is not to criticize Patrick Bet-David. Again, I don't know anything about him. He seems to be very successful. All I wanted to do was take him up on his offer where he said, if you disagree, go ahead and tell me why, but tell me what data. And the same thing, I tell you, if you disagree with me, absolutely go ahead and disagree, but come at me with data. And Patrick Bet-David, if you watch this video, happy to chat. You know, I'm happy to give you my point of view and listen to yours. So I hope you got something out of it. Until next time, take care.